Hey guys, I know a lot of people are still trying to log on, so we are live, but we're going to give it another minute or two just to make sure everyone has a chance to log in before we get started. All right, so it looks like a few folks are still joining, but we'll go ahead and get started. First of all, appreciate everyone taking your time to jump on with us and listen to this presentation. Unfortunately, I can't see you guys. I would love to say it's great to see everyone, but you only get to look at my face, and I can't see you. But again, I greatly appreciated for you guys joining on. Before we start, just wanted to kind of tell you a little bit about Foley and Lardner. I know a lot of you guys know that's where I am now. And one of the great things about Foley is, from a culture standpoint, it's very similar to IOA in the sense that there's a very strong culture of partnering. So much like you guys, if you get a prospect or a client that has a certain area of expertise that you need help with, you can go find someone to partner with. I have the same ability at Foley. So we have roughly 1,100 attorneys. At this point, I've been able to help IOA producers with a variety of things, whether it's litigation, employment matters, fund formations for developers, and kind of runs from that. So again, a lot like you guys, if you have a legal issue, you have a client with a legal issue, love for you guys to reach out, and probably good chance I'll find somebody within the firm that's an expert. So when we started talking to Jeff about doing this presentation, with reps and warranties, one of my partners that I reached out to immediately was Ethan Lenz. Ethan is the chair of our insurance practice group here at Foley, which I'm a part of. And, among all the other things that he's an expert in, he's kind of our resident go-to when it comes to reps and warranties insurance. And so probably the best guy to lead this is Ethan, and I'll turn it over to him at this point.
All right. Thanks, Tony. Appreciate everybody joining today, and hopefully we will, if nothing else, give you 1 or 2 points that you can walk away from this, make you a little bit more educated and smarter about rep and warranty insurance. As I go along here today too, feel free, there is a Q&A section, and feel free to throw any questions in there. I'll try and catch them, or Tony will give me a heads up if they're there, and happy to answer them as I go along. I think it makes hopefully keeps me from droning on and everybody falling asleep during this thing. Give you a little bit of background on myself. I've been with Foley for about 20 years now, a little bit more than that actually, and I am the chair of the insurance practice group. My practice is largely focused on providing insurance coverage and risk management advice to our firm's corporate clients. And the last few years particularly, that has involved a lot of advice on rep and warranty insurance, as it has taken off just sort of phenomenally, to the point that it's used on almost every private company deal these days. So it's a real, it's a source of, I think probably real potential revenue for some of you. Good way to grow your book of business. And so with that, I'll just kind of jump into it here. Little bit of back, and I'll warn you, I've got these slides, but I don't necessarily follow them real closely. I'm not going to just sit here and read from the slides to you. So I'll just kind of riff. And again, you got questions, break in, ask them. Be happy to try and answer anything. But, you know, the way I've got this set up is going to start out talking a little bit about, you know, what's the rationale behind rep and warranty insurance? Why did it why has it come into such prominence in the last 5-6 years or so? Then go over a little bit, kind of a high level overview of what the current marketplace looks like, who's using it, an overview of some of the main coverage terms and conditions, types of deals it's being used in. We'll talk about some of the trends in the coverage in terms of, you know, the limits that people are buying, deal sizes that you use it on, retentions, premiums, things of that nature. And then I'll end up talking just a little bit about sort of how the process works, because it's a little different probably than a lot of insurance products that you might be more familiar with. So with that, kind of, you know, the background of rep and warranty insurance and the problem it's trying to solve. So, you know, obviously it is used in mergers and acquisitions. Somebody's selling their business, and you know, there is a purchase agreement that's drawn up by the lawyers, and traditionally those purchase agreements, they contain all kinds of representations and warranties that the sellers are making to the buyers about the business. There will be things like, you know, the business is properly legally organized. It's got a, you know, a certificate of authority in its state of domicile, things of that nature. There'll be reps with respect to the fact that, you know, the shareholders appropriately own the shares. They hold good title to them. Might be reps on employee benefits plans, the fact that, you know, the plans don't have any undisclosed liabilities. They are, you know, they comply with law. There'll be reps on the financial statements saying our financial, you know, the financial statements that we've given you for the business are prepared in accordance with GAAP and they're true and correct in all material respects. So there's all these reps in the these agreements that get written up to sell a business. And traditional way it was handled is that in order to cover the eventuality that some of those reps might not be true, because, you know, well, yeah, it can be any number of reasons. The sellers might not have, you know, they might have just inadvertently not disclosed something. You know, some sellers lie, cheat, and steal. They might have advertently not disclosed something. Fraudulently, they forgot. They really didn't forget. They just were lying when they sold the company. But in order to cover those eventualities, that some of those reps in the agreement might not be true, and if those reps in the agreement that you got aren't true, the business probably isn't worth as much as you paid for it. So to cover that, sellers would typically have to leave behind some portion of the purchase price. A lot of times it was 10 to 20% of the purchase price. So you did you know, just to use round numbers, had a sale of a business for $100 million. The sellers would have to, the sellers a lot of times would be leaving behind 10 or $20 million in an escrow account in case some of the reps didn't turn out to be true. And so really what, you know, one of the big drivers was private equity in the US sort of exploded. And when it did, private equity particularly, they did not like leaving money behind in escrow accounts, because what they wanted to do is they were selling a business. Usually that business was part of a particular fund for the private equity investor. They wanted to be able to close out their fund, take their cash that they made on the deal, move on to the next deal, buy another company so they could flip that one. They didn't want to leave the money behind. That was one of the real drivers for rep and warranty insurance really coming into prominence, because the problem it's trying to solve at the end of the day is that seller escrow, that leaving, you know, that $100 million deal, you know, allowing the sellers to walk away with almost $100 million on the date they close the deal versus 80 or 90 million, and then having to wait another year or two to get the other 10 to 20 million out of escrow once the buyers decided that there weren't any breaches of the reps and warranties. So that's, big picture overview of sort of how this business, how the whole rep and warranty insurance business sort of started to develop. And rep and warranty insurance, I mean, it's been around for, it started getting kicked around probably in the late 90s, early 2000s. I'd heard of it. Really didn't get any traction though for a lot of years, and really has just been the last, I'd say, 6 to 8 years maybe, where it's really taken off phenomenally, to the point that now we're seeing it not just in private equity deals, but in almost every sale of a private company, it's at least a discussion point. So this whole gibberish about in the slides about, this is a risk allocation tool. Yeah, it is. It's basically moving the risk of a breach from the sellers to an insurance policy and giving the buyer an insurance policy to hit in the event there's a breach of one of these reps on, whatever it is, ownership of the shares, financial statements aren't correct, all those different things. One of the other things that rep and warranty insurance did also is that when you had these traditional deals where a seller was leaving behind money in escrow, the sellers would want to get that money as soon as possible. They'd want to get that money back out of escrow as soon as possible. So you usually ended up with like a 1 or 2 year period in which the buyer could make claims for breaches of reps and warranties. Once insurance, one of the big advantages that came along when the insurance products started getting developed for rep and warranty insurance is that these periods got extended, and that's what really kind of started making buyers interested in this. At the end of the day, buyers in most cases, they'd prefer to have cash in an escrow account to grab versus having to hit an insurance policy. But then the insurers figured that out, and they said, well, what are the carrots that we can give the buyers in order to really get them interested in this stuff? And one of them was an extension of the period to make claims. And so most of your policies these days allow claims to be made for somewhere between 3 and 6 years versus that traditional sort of 1 to 2 year time period to make claims for breaches of the reps and warranties. So again, these couple of slides, they really just kind of cover what I was talking about there. Again, it's third-party insurance coverage for breaches of the reps and warranties. Where are we seeing it utilized? Like I said, almost every private company acquisition. Also see it a lot. What you see more and more these days, well, maybe this will change a little bit with the current M&A environment. M&A is down compared to what it was a year or so ago. But you were seeing a lot more auctions for companies. Seller put their company on the block, and they would have an auction process where they'd solicit bids from, they'd hire a investment banker, they'd solicit bids from a number of different potential buyers, have essentially a mini auction process. And one of the things that helped to distinguish buyers in some of those processes was their willingness to buy rep and warranty insurance. When you had, you'd have a lot of deals where there were 5 or 6 different potential bidders who were competing for a company. And if 1 or 2 of those bidders said, yeah, we're willing to use rep and warranty insurance, they usually moved to the front of the pack, even if their bids were a little lower for the selling company. So it was a big advantage for that as well, to sort of distinguish yourself. See, we got a question here. What about large investment into an existing company? Is rep and warranty coverage useful then? Potentially, yeah, the answer is potentially yes, because if you're bringing in new money into a company, a lot of times, depending on the size of the investment and everything else and how it's structured, but a lot of times you'll have something very similar to a full purchase agreement. You'll have a lot of those same rep and warranties that you're giving to the new money investor. And, you know, as long as you've got reps and warranties, you know, that's something, as long as you've got reps and warranties in the agreement, that's something that a rep and warranty insurer will potentially look at covering. So yes, it doesn't have to be a full sale of a company. It can be a new money investment as well, where you're using this type of product. A few of the other reasons that you know, rep and warranty insurance really started to take off. Originally, you know, and this was probably, you know, 10 plus years ago, the premiums were just too high for it to make sense. The insurers were, you'd have a $10 million policy, and the all-in cost of the policy would be $1 million or more. It was really hard to attract many people to buying that. Well, insurers got more and more comfortable with the product, and the fact that at the end of the day, there aren't a lot of claims often brought on deals, or at least claims that stick for breaches. They got more, the insurers got more and more comfortable. They brought on a lot of M&A lawyers into, you know, to do their underwriting. So they got smarter about deals and everything else. The premiums started coming down, the deductibles started coming down. And that's when, you know, the product sort of really took off. Again, you know, it was private equity that really sort of started this trend again, because that their want to walk away from deals with as much cash as possible. But it is, you know, I probably work on, you know, 50 to 100 deals a year now at Foley. That's just at Foley and Lardner, where where rep and warranty insurance is being used. It is almost every privately held company. If it's selling, you know, I tell my colleagues, if we're representing a seller and we don't discuss rep and warranty insurance with them and potentially push buyers to use that as opposed to traditional escrow, I think we're committing malpractice. So, you know, if you have clients that, you know, have privately, you know, they own their own businesses, they're looking at selling them, you know, this is something they should really be thinking about. It's just used in so many deals and has become so ubiquitous that, you know, it really is something that should be a discussion point in every private company sale.
Hey, Ethan, we have one more question at the bottom.
Yeah, I just caught that. All right. Is a new policy purchased for each deal, or do some private equity firms have rolling policies that cover all of their activities? I have not seen a PE firm that has a rolling policy. It is typically a new policy for each deal. Part of the, you know, a lot of the PE firms will consistently go back to the same, and if they have had good luck with an insurer in terms of placing policies, ease of placement is a big thing, and the efficiency of placing it. If they've had good luck with a particular insurer, they'll go back many times to the same insurer. But I haven't seen sort of a roll-up type policy. And part of the reason for that is, you know, usually the limits of the policies are set as a percentage of the deal value. So again, that $100 million deal, you're doing a $10 to $20 million limit policy. You know, if you turn around and you do a $50 million deal, you're usually only doing $5 to $10 million at most in limits. So the limits are driven as a percentage of deal value. Also, the deductibles are as a percentage of deal value, and each deal is different in terms. The other thing is, and we'll talk more about this later, but each deal is different in terms of what the real risks are. Because one company, you know, for one deal, it might be, oh, there's a bunch of red flags with respect to the financials for this. So we're going to have a bunch of exclusions related to the financials for this deal. The next deal, it might be misclassified. They've misclassified a bunch of the employees as independent contractors. So we need different exclusions for that policy. So usually you see a different policy for every deal. One of the other things should just mention quickly here is there are two different types of rep and warranty policies. One's a buy side policy. Buyer, the buyer acquiring the company gets that policy and they're the named insured. That is by far the most common policy. There are seller side policies where the sellers who are making the reps and warranties also buy the policy and they're the named insured. The reason the sell side policies are much less common is they don't solve the problem of allowing the seller to walk away with cash versus leaving an escrow behind. So the problem is if you have a seller side policy with the seller as the named insured, if the buyer buys the company, they get all these reps and warranties in the agreement, and then there's a breach of a rep and warranty. Buyer if there's a sell side policy, the buyer doesn't have an insurance policy to hit. So they've still got to have the escrow, that 10 to 20% of the purchase price from the seller sitting there to hit that for their breach. Then the seller turns around, and if their escrow gets hit, they then have to hit their insurance policy and try to collect from that because they're the named insured on the policy. So reason sell side policies are just a lot less common is it doesn't solve that problem of letting the seller walk away from the deal with the money they would have otherwise left in the escrow. They're both claims made type policies. Again, buy side policy pays the buyer directly. If there is a breach of a rep and warranty that's discovered after closing, buyer makes a claim directly against the policy as opposed to making a claim against the seller. Another big difference between the buy side policies and the sell side policies is seller fraud. In a buy side policy, seller fraud is covered. And so logically it makes sense because buyers don't know that they're being defrauded by the sellers. And so it's an unknown risk when they buy the company and they get these reps and warranties and find out that the sellers hosed them. They didn't know about that, so seller fraud is picked up by a buy side policy. Seller side policy, seller fraud is not going to be picked up. Sellers can't lie, cheat, and steal, making their reps and warranties, and then get hit with a breach claim, and then turn around and hope to get reimbursed by an insurer for their own fraud. A couple other things. Again, reiterating the 10 to 20% of deal value. Those are your typical limits. There are insurers out there now who are offering more specialized excess products as well for coverage of fundamental rep breaches. Fundamental reps, a lot of you probably know, but fundamental reps are the are reps as to we own the shares of the company. Company has been duly organized under applicable corporate law. They're real basic reps, but they're reps that are things that are, quote, fundamental, because if they're bad, if those reps are bad, the whole deal, the significant part of the deal value would be lost if those particular reps are breached. So some insurers are now offering excess coverage. It's a lot cheaper, typically under 1% of the limits, but they'll offer that coverage up to the full limits of the deal. So the full value of the deal. So you do a $100 million deal, you can potentially get your fundamental reps and your tax reps covered up to that whole $100 million. All right, two of the just high-level benefits to the buyers. One's a collection issue. again, a lot of times, a lot of the money was left in escrow to cover the breaches. But if the buyers had to chase a seller after closing for breaches, to the extent they had losses that exceeded any escrows that were left behind, a lot of times, your sellers are gone. They're gone, and they don't have any money, or they're real hard to find. That money is real hard to find. So, one of the big benefits to buyers, again, is on the risk of collection. You've got an insurer with a deep pocket to potentially hit. Again, this idea of including the policy as part of a bid and an auction process, potentially, a distinguishing factor to help a buyer get a company that has many different people bidding for it. And again, those longer survival periods for the reps in terms of being able to hit for potentially up to at least 6 years versus the 1 to 2 years. Another big benefit to buyer of these policies is, it used to be a real, it would take a lot of back and forth on the reps. And the negotiation of those reps and the scope of them and exactly what they said, there could be potentially months of back and forth between the lawyers on exactly how the reps were going to read for a purchase agreement. Well, with the advent of rep and warranty insurance, the sellers don't really fight nearly as hard on the reps any longer because they have little or no skin in the game. It's getting risk is being transferred to an insurer, so the sellers don't fight near as hard, and it's become, the insurers have accepted for the most part now purchase agreements that are written in a relatively buyer-friendly way from a rep and warranty standpoint. The insurers have made the business judgment that they are making enough money off of this product. They're collecting adequate premiums, and they can insure a buyer-friendly product in order to make the rep and warranty policy something that buyers will accept. Because at the end of the day, if the insurers were really cutting back on the reps that they would cover, they'd have a real hard time selling it to buyers. So it creates, one of the big benefits to buyers is it creates a much less adversarial deal process because you don't have to negotiate those reps and warranties nearly as hard or take nearly as long on them as you used to. Another big benefit is there are a lot of times are different reps and warranties, particularly with respect to certain things in the financial statements where if something is misstated, it can lead to issues where that problem continues to go through the financial statements for any number of years. And so, there will be, it might be a $1 million loss from the particular financial statement you're looking at, keeps flowing through the financial statements, and it might be actually a loss of $5 or $6 million because it just keeps multiplying itself in future or past years, depending on what the issue is. Also, a lot of times buyers are valuing companies based on some type of a multiple of the company's prior year earnings. It might be 13 times the prior year earnings or the prior 3 years earnings or something like that. And if they're doing that and those earnings were misstated in the prior years, now again, you got that $1 million difference in earnings could be a $13 million difference in the price that was paid for the company. A lot of insurers are willing to provide coverage for those those claims based on multiples of earnings or other multiplied damages. And so that makes it again a real attractive product from the buyer standpoint. Also, another big area where rep and warranty insurance is used is financially distressed companies. If a seller is in bankruptcy or near bankruptcy, again, traditionally there was a real problem. You as a buyer were having to, sort of take that company as it was. They usually couldn't leave any money behind in escrow, and so you had to heavily discount what you were paying for the company, and had no recourse if reps and warranties turned out not to be true, because the seller couldn't leave anything behind and they didn't have any money if you ever had a claim against them. Now you can put a rep and warranty policy in place and actually cover that risk, and it actually leads to, for some financially distressed sellers, a higher purchase price for the company. Last big benefit to buyer, rollover deals. And these have become more and more, I think, more and more prominent in recent years. And the idea here is usually some of the management of the prior company, of the selling company, is coming along, and they're getting equity in the buyer or the post-sale company, and buyer doesn't want to have to make claims against those rollover equity holders, because they're relying on them. Usually they were equity holders in the company pre-sale. Now they're going to be equity holders in your new company post-sale, and they're also going to be executives you're relying on to run the company. You don't want to be making claims against them, because obviously it creates a very sticky business situation if you're all of a sudden making claims against your current executives, who you're relying on to run the company. So another real benefit to buyers is instead of having claims against those pre-sale equity holders who are now post-sale executives of the company, you can instead hit the insurance policy, not have to hit your ongoing business relationships in order to recover for a claim as a result of a breach of a rep and warranty. Got the wrong title on this slide. It should be benefits to sellers. Again, and I think we probably hit on most of these. For the sellers, it's that lower amount of caps and escrows that they have to leave behind. They don't have to worry about being on the hook for a couple of years, and again, expediting the sale and increasing the purchase price. Again, you're not negotiating those reps and warranties nearly as hard as you normally would have to, and at the end of the day, you can potentially increase your purchase price because the buyers have a known quantity that they can hit in the event of a breach. Talk a little bit about sort of how the coverage works, what people are doing in terms of the scope of coverage, the limits. Used to be that you needed a deal size of at least about $20 million, sale price of at least about $20 million in order for rep and warranty insurance to make sense. I'm not sure that's really the case anymore, especially these days. The market has turned just in the last 4 to 5 months probably. It was, we're coming off a period where M&A activity was just so hot and heavy that the underwriters that were available for rep and warranty insurance, they were running out of capacity. Most of these most of your rep and warranty insurance, it's written on a surplus lines basis. I think it all is, not just most. It's all written on a surplus lines basis. A lot of it is underwritten by MGAs. They do the underwriting for consortiums of insurers. And for the last couple of years, particularly at the end of 2021, the MGAs in particular, they were running out of capacity. They had limitations on their capacity, and they couldn't write any more deals. Well, because there was just so much M&A going on. Well, in the last 4 or 5 months, at the end of 2022, with the increasing interest rates and everything else, M&A activity dropped off pretty precipitously, and the insurers are scrambling for deals now. So, it used to be, in order to get a lot of the traditional rep and warranty insurers interested, you had to have that $20 million deal size. I don't think that's really the case anymore. They will write smaller deals with limits down to, I've seen them recently, even the $2 or $3 million range. Used to not make sense to do those smaller deals because most of the insurers had minimum premium requirements of somewhere between $150,000 and $200,000, and so you'd run into these. You'd try and do a $2 million policy, and it was costing $200,000 plus to place that policy. That didn't make a whole hell of a lot of sense because the premiums were just too much for the limits that you were getting. Now there's a lot of markets. There are a number of markets developing for even the smaller deals. So you don't necessarily need that $20 million plus deal any longer in order to do these. The policy coverage, typically, again, 10 to 20% of the deal value. So you're doing that $100 million deal. You're usually doing policy limits of $10 to $20 million. Probably militates more towards that $10 million range most of the time. The length of the coverage. So the coverage is split between those fundamental reps, those reps that we, the shareholders, own the shares. We have good title to them. Company was duly organized under applicable law, those types of things. And then all the other reps, the employee benefits reps, the financial statement reps, all those. So those fundamental reps, you get 6 years of coverage typically under a rep and warranty policy. Then those other reps, which most M&A lawyers will call them the general reps, you get 3 years of coverage for those. Doesn't matter if it's a buy side policy or a sell side policy. The length of the reps and warranty, the survival on them in the policy is usually the same. In terms of the scope of the reps that are covered under the agreement, and there will be, you look at a purchase agreement, I mean, there will be pages and pages of, it's the bulk of your agreement, your purchase agreement, a lot of times are the reps and warranties. So, there might be 20 or 30 pages of reps and warranties in some of these purchase agreements. And usually your rep and warranty insurance will cover all the reps and warranties that were made by the sellers, subject to exclusions, of course. You can buy policies that are structured to just cover certain reps. Usually doesn't make much of any sense because, I saw this early on where people would try and do this where they covered just a subset of the reps and warranties that were being made. But what ended up happening is, well, look, the same reps and warranties that you as a buyer are really worried about being breached, those are the same ones that the insurers are really worried about. They're going to have to end up paying a claim on. So you try and carve out a certain subset of reps to get covered. You're not going to save much in terms of premium at the end of the day, usually for the buyer. And what happened 9 times out of 10 was the things you were really worried. You'd buy that limited rep and warranty policy for just covering just certain reps and warranties. And of course, a rep and warranty outside of those would be breached and cause all kinds of losses, and you don't have a policy to cover it. So the vast majority of policies that are written these days, they cover all the reps and warranties that are made in the purchase agreement, and that's typically about the only way to go. So then you, of course, like any insurance policy, you've got exclusions. And the exclusions break down into basically 2 categories. One are the standard exclusions that you're going to get with every rep and warranty policy. And then the second category are the deal-specific exclusions. Standard exclusions are going to be for things like breach of the covenants. Covenants are, you may know this, but covenants are things that people say they're going to do in the future. The buyer will make the purchase agreement might include a covenant not to compete, but the seller won't compete in the same business with the buyer post-closing. things you're going to do in the future, as opposed to, the current status of the company, which is what the rep and warranty policy is meant to cover. So covenants are excluded by every rep and warranty insurer. Almost every merger agreement or purchase agreement contains a purchase price adjustment. There's usually based on the net working capital that is available versus expected to be available. But purchase price adjustments are a common thing that buyers and sellers have in their agreements, so they can kind of true up everything for the way the business actually looks on the date of sale. Those are not covered by the rep and warranty policies. Known breaches, about something at the time of the sale, that's not going to be covered. If there are any known environmental issues with the target company, there's almost always going to be a broad environmental exclusion. The position of the insurance industry is that, there's separate coverage available for that. You go out and buy an environmental policy to cover the environmental issues if those are known and existing. And then a few of the tax representations, particularly on net operating losses, no rep and warranty insurer will cover those. And then you get the deal specific exclusions. So the way those work is, the whole premise of rep and warranty insurance is, the buyer has done good due diligence to confirm that the reps and warranties that they're getting from the seller are true. And the buyers have to give, they have to give the insurer their legal their outside law firm's report showing that they looked at the reps and warranties. They did their investigation to determine that those reps and warranties were true. And, after doing that investigation, they're reasonably satisfied that they are true. And so the whole game with rep and warranty insurance is, despite the buyer having done good due diligence to determine the reps and warranties were true, something comes out of the woodwork and one or more of the reps wasn't actually true, and there's a claim. So the deal specific, that gets me back to the deal specific exclusions. If the buyer is doing their due diligence and they come up with things that are, this is a big red flag. There's something wrong with this particular part of the financial statements. Doesn't look like they were appropriately accounting for their inventory. If you have those red flags in the diligence, usually those are going to end up being deal specific exclusions in the policy. And so the trick from a buyer standpoint with rep and warranty insurance is that you got to do enough due diligence to satisfy the insurer that you've uncovered most things, but you don't want to go overboard and identify every little thing that could potentially be wrong with the business, because to the extent you start identifying things as red flags that could be wrong, the insurers are going to add exclusions to the policy. So it looks like we might have another question here on tax exclusions. It was recently asked for insurance to cover a developer in the case they lost a tax credit status. Could this be included in rep and warranty, or is it a separate product? It's actually, that one is a separate product. There are insurers that are not, a lot of the same insurers as underwrite rep and warranty insurers, but they have separate tax insurance policies. And so they will cover single tax issues such as this, where there's a tax credit that could be, there could be issues around whether or not that tax credit is valid and will withstand IRS scrutiny. But yes, there are separate policies you can buy for those. They are very similar at the end of the day to a rep and warranty insurance, but they are typically written in a slightly different policy form. And one of the big advantages of those tax insurance policies is they save someone from having to go out and get an IRS ruling in order to satisfy themselves, which could take those IRS opinions and rulings can take months, if not years, to get. If as long as you're able to have a law firm that can write can give the insurers reasonable comfort that the tax credit is valid and supportable in the face of an IRS challenge, you can buy an insurance policy and you can usually put that policy in place, in a month or less of time versus, several months or years potentially trying to get an IRS private letter ruling. But yeah, so long way of saying, yep, those policies are available, but they are a different product than the rep and warranty policy. The rep and warranty policies, they do have a retention on them. Usually it is around 1% of the deal value. So again, you're doing that $100 million deal. You might have a $1 million retention on that. If you're doing a $20 million deal, $200,000 retention probably on the policy. It's an aggregate retention, so no matter the number of claims, the retention only applies once. You bring it down, you might have 5 different claims, but you're only going to have to bear that retention one time. Also, those retentions typically get stepped down after 12 months from closing. And here the idea is, and this interplays with the purchase agreement. And that's another point I should make is, there are a lot of nuances and things that need to go into a purchase agreement in order to make sure that it works with a rep and warranty insurance policy. Now, if you have clients who are doing these deals, that's might be one of those things where Tony and I hope that you'll give us you'll give your client our names, and we do a lot of these deals, and there are a lot of nuances and things that have to be negotiated into the purchase agreement just to make at the end of the day, I say a lot of things, but I don't know if it's a lot of things, but it's a lot of it's a few important things that need to end up in the purchase agreement in order to make sure that you're maximizing your rep and warranty coverage. You want a lawyer looking at that purchase agreement who knows how this product works and what needs to end up in that purchase agreement. Gets me back to this idea of the retention dropping down after 12 months. So you start out with that 1% retention. We'll stick with that $100 million deal. You started out with a $1 million retention. After 12 months, it usually drops down to 0.5% of the deal value, or $500,000. Reason for that is that in the purchase agreement, usually, I said the sellers don't leave, the sellers got to get away from leaving an escrow behind. Usually they still leave a very small escrow behind of 0.5% of the purchase price. So this is the way most deals end up working, is that you have that $100 million deal. Old days, seller would have left $10 million, 10 to 20 million behind in an escrow. The new way that these work with rep and warranty insurance is seller now only leaves $500,000 behind. And if there's a breach of a rep or warranty during the first year after closing, usually the buyer pays or bears the retention up to $500,000, 0.5% of the purchase price. Seller then, if the losses exceed $500,000, the sellers bear the next $500,000. That comes out of their escrow. That gets you to the $1 million retention on the policy. And now the buyer hits, once the losses exceed $1 million, the buyer hits the policy for the rest of it. So that's that reason you often have that step down or drop down retention on a rep and warranty policy. Cost of coverage, yeah, the price on rep and warranty insurance, like I said, 10 years ago, it was 10-12% of the policy limits. Then it really dropped down, and when it really got popular is the prices dropped down to about 3% of the policy limits. So you did a $10 million policy, pricing was right around $300,000. Back in late 2021, early 2022, because of the some of these capacity crunches that the insurers and the MGAs got into, that pricing started going back up to the 5 to 7% range, and it kind of hung there through until about the end of the summer last year. Now again today, those prices are right back down to about 3 to 4% of the policy limits in most cases, sometimes even a little less than that. And that 3 to 4% typically includes 3 or 4 components. One is the premium for the policy. 2 is an underwriting fee for the insurer. So every insurer will charge an underwriting fee. Usually it's something like $35,000 or $40,000. That's to cover. They usually bring in, the insurers usually bring in an outside law firm. I'll talk a little bit more about that here in a couple of minutes. They usually bring in an outside law firm to help them look at the deal, and so they charge an underwriting fee up front of $35,000 to $40,000 on top of the premium, and then you have surplus lines taxes. There are also particularly the larger brokers that charge additional fees on top of a broker fee. On top of that, typical arrangement is 0.75% of the policy limit with a minimum fee of somewhere between $50,000 and $75,000, usually reduced by the commissions paid by the insurers. So, on a $10 million policy, some of the brokers are guaranteeing themselves that they're making a minimum of $75,000 on that policy if they're charging 0.75 points. And again, usually that gets reduced by any commissions that are paid by the insurers. Then the buyer or seller who is ever paying for the policy pays the remainder of that to the broker. The premiums and the other costs are a one-time expense. It's not these policies stay in effect for, typically a total of 6 years, and it's, one-time upfront expense. A lot of time, in a number of deals, you will have what's called a split sign and close, where the deal will be signed, and then some of the things, it might be Hart-Scott-Rodino approvals or other governmental approvals or any number of different reasons. You might sign the deal one day, and then 60 days later, you actually close it. A lot of times, insurers will require a 10% down payment on the premium at the time of signing, and then the remainder of the premium gets paid at closing. In terms of who pays the cost, my experience is the insurers don't care who pays the cost as long as they get their premium paid. Most deals, I would say the majority of deals, still the sellers and the buyers split the cost 50-50. Definitely had been a trend when the M&A was running hot and heavy, and there was a lot of competition for almost every deal, where buyers were more often paying all the premium for these policies. In terms of the actual process, usually I advise my clients to plan on it taking 3 to 4 weeks. The reality is you can put a rep and warranty policy in place probably in about 2 weeks' time if you have to do it. And typically the way it works is, you have what I call phase one, which is where the client goes out, they engage the insurance broker, and then in order for the broker to go out, for you guys to go out and get quotes on these policies, typical things that most insurers want to see in order to give a quote, they want to see an early draft purchase agreement. certainly does not have to be a final draft by any stretch of the imagination. They want to see financial statements of the target, and they want to see, if there's a offering memorandum or a confidential information statement, or sometimes you can even just give them the web address for the target company. They just want to understand what the business is that's being acquired for that offering memorandum point. So you have those three things. Really, usually you enter into a confidentiality agreement as well, because a lot of times the buyers will be under a confidentiality agreement with the sellers that they won't disclose the seller's information. A lot of times then you as brokers would be made a party to that confidentiality agreement and be expected to get it from all the insurers as well. So you get those three main things: that purchase agreement, those financial statements, and the offering memorandum. That'll usually allow you to shop the coverage, and it's usually, it says 2 to 3 days. It's probably more like 3 to 4 days. Process. Most of the initial quotes will come back from the insurers, and there's usually no charge for those initial quotes. Insurers usually offer those at no fee, so nothing has to be paid for that. And those initial quotes will usually identify, estimated premium for the policy, which is dependent on the limits typically, or at least largely on the limits. And I rarely see those estimated premiums move after the initial quotes. I don't know if I ever have, seen them move materially, to be honest. And then the other things the quotes will identify are if there's any anticipated deal specific exclusions that the insurers just see right away up front. Oh, there's a known problem with this particular company or this particular, business line of business. So we're going to add this particular exclusion. And then usually those quotes also include, something that's called areas of heightened underwriting concern, which those are, that's insurer code for, these are the areas of the buyer's diligence we're going to look really closely at. We're going to expect, that the buyers dotted all the I's, crossed all the T's, made sure that the reps in these particular areas are true. So they're the things we're going to look really hard at, and they're the most likely things that are going to lead to additional exclusions in the policy at the end of the day. And the other things would be the policy periods, what the retentions are for the policy that the insurer is quoting, and their premium and underwriting fees. So that's phase one. That's that phase one. Then you have, what I call phase two, which is the due diligence phase for the insurer, and usually that's about 7 to 10 days. And at that point, you got those initial quotes back. Then the buyer has to pick an insured that it's going to pick one insurer that it's going to go with. Once it does that, it typically has to pay that underwriting fee. Those usually run, anywhere from $25,000 to $40,000. That's a sunk cost, whether the buyer ends up, taking the policy at the end of the day or not. Once they engage a particular insurer and ask that insurer to start doing the underwriting, you got to pay that fee. That fee is a sunk cost. And once that fee is paid, then what the insurers are going to do is they do what I call mini due diligence. They are going to get into the data room, look at what, the various things that a seller has put in there, and they're going to poke around in that, do some mini due diligence, not nearly what the buyer's counsel presumably did. But they're going to look at stuff, just to kind of do a high level analysis of, does it look like, the buyers or the sellers have disclosed everything, and are there any, major, things that are missing in the data room or things that look really problematic. Then after that, the buyers are going to have to provide the insurers with their legal counsel, usually their legal counsel, their tax counsel, and any outside financial advisors they've hired. Usually they'll have reports from all of those that they'll provide to the insurers. And then 2 to 3 days after the buyer turns over those reports to the insurer's counsel, you'll have an underwriting call, usually lasts a couple of hours, in which the insurer and the outside lawyers that they've hired for the deal get to ask the buyer and the buyer's deal counsel questions as to particular reps, particular disclosures that have been made. How was the diligence done? What depth of diligence did you do on these particular subjects? Any areas that the insurer has, questions about, are sort of open for discussion on that underwriting call. Then after that, you usually get, a set of follow-up questions from the insurer for things that maybe weren't answered or weren't answered to their satisfaction on the due diligence call or the underwriting call. You'll then get a copy of the policy. They're all manuscripted policies. So, the language is highly negotiable. Another thing that, we do for our clients all the time is, help them with negotiating the final language for the rep and warranty policies, because they are, they're manuscript policies. Insurers are highly willing to negotiate the final language of them. And then after that, you are to the binder stage. Policy is bound and put into place, and you have your rep and warranty insurance policy done. So that's my story. I'm sticking to it. I would be happy to answer any questions that anybody has.
So Ethan, I have a question. So with the current landscape with M&A deals and, maybe they have potential private equity clients that are looking to still acquire things. I don't think it's going to be at distressed values, but I certainly think multiples are going to be lower than they have been. I mean, do you see anything they can use with their clients in light of where we are in the M&A space, maybe outside of what we talked about? I mean, is there any additional value? Because I think it's certainly going to be a buyer's market, right? I think that's where we're going. So would there be any additional advantage, in this type of environment for reps and warranties? Or is it probably still the same?
Yeah, I mean, I think the advantages are probably still largely the same. I think what you're probably going to see a shift back, and there was a decided shift towards the buyers, bearing more and more of the cost of the rep and warranty insurance policy, and also saw a lot more what are referred to as no indemnity deals, where the sellers basically, they walked away. They weren't even responsible for any part of the retention or anything else on a deal. I think you're going to see those go away. I think you're going to see more deals where the sellers are now the policy costs, or at least 50% of them gets shifted back to the sellers. And you're going to see a lot more deals where the sellers are going to bear a bigger part of the retention under the rep and warranty policy. I don't think the policies are going to go away. Even in a more buyer-friendly market, I think they become so ingrained now that the likelihood that they're going away anytime soon is unless for some reason all the rep and warranty insurers were to get hit with an abundance of claims and tank. I don't think this market's ever going away. I think the M&A landscape is forever changed.
All right, so we've exceeded the hour again. Unless anyone has any questions, obviously you guys have my email. You can shoot me an email if you have any questions, and if I don't know the answer, I'll have Ethan, get involved. I think maybe the one takeaway that I would like to kind of reiterate from Ethan's standpoint is it's, when we started looking at this, I asked Ethan, I'm like, okay, well, when do we need to get Foley or the attorneys involved? And I think that his point is, it's crucial if you have a client that's considering doing an acquisition, that whether it's me or Ethan or whomever, be involved, at the purchase and sale agreement stage, and not after you have an executed purchase sale agreement and then think about you want to go get the policy, because I think to his point, it's important that the language in the purchase and sale agreement kind of jives with the policy. So again, appreciate everyone jumping on board. Look forward to seeing you guys at the sales meeting, and we're here if you need help. So I appreciate it.
All right. Thanks, everybody.